So, capital adequacy standards, right, of the banks. So, there are three pillars of capital adequacy. There's minimum capital requirements and supervisory review process, and then effective use of market discipline, which is we're going to highlight about again in Basel II Accord, something called Basel II Accord. Pillars, the important three elements, I say. Okay, so we need to discuss something about the Basel Accord. Basel. The yodel song, you can think about it. Switzerland, Basel. Yes, this is the place. Why do we bother? Basel. Well, this is the place where we have Bank of International Settlement, Bank for International Settlement, right? It's not Bank of, this is Bank for, so which is called BIS, right? Bank for, I should say Bank for International Settlement, which is in the middle of Basel, the city of Switzerland. And Switzerland, you see it, yes, over there, those trains, and then beautiful place, right? And one thing to notice is that head of research, chief economist of BIS, right, is Professor Hyun-Song Shin, a South Korean guy, right? He is also a Princeton University's economics professor, finance guy, okay? Greatest theorist in financial world, right? Academia as well as in practice. A fantastic guy. So go ahead and watch his profile and then try to follow his footsteps if you're interested in academia, okay? And then this one, Basel Accord 1988, BIS ratio. The Bank for International Settlement was established in 1930, long time ago. Okay, they needed some place that should be working as a, how do you say, middleman in settling those transactions somehow. Okay, so that's why it is called Bank for International Settlement, right? Giving and taking transactions, all those things have to be settled and the market has to be cleared. Central bank for clearing international transactions between national central banks. So Bank of Korea, no, at that time we did not have Bank of Korea. Bank of, I don't know, England, and then Federal Reserve or Deutsche Bundesbank, right? Their transactions had to be settled in BIS, that's why. Facilitator in reaching international banking agreements among its members, right? That's the purpose of this bank for international settlement. You go ahead and watch their, explore their website, please. And then this one, okay, they had some accord or contract kind of things among member countries in 1988. We call it Basel Accord, okay? There they created something called the BIS ratio. What the heck is that? BIS ratio used to be the hottest issue for South Korean economy and finance ever since 1997 financial crisis. So BIS, if you talk to your parents, they will be like, wake up in the middle of the night, right? Even though they are not finance guys, they will be like, BIS ratio, why? That's an important thing. Why? Right? Why? It's easier way to waking them up because it is associated with traumatic experience in 1997. We're going to get back to that issue later on, right? And then BIS, Basel Accord, what was that about? Well, it was about this buffer capital ratio, okay? Compared to your something called risk-weighted asset, not the total asset as you see it, but something called risk-weighted asset, okay? How big is this buffer capital, okay? So total asset, actually total asset in your balance sheet will be, I should rewrite it a little bit in the whiteboard, okay, like that. So the idea is your balance sheet total asset will be like this huge amount. Okay, so total asset. Okay, total asset. But some of the assets over here may be risk-free. For sure, you just have it. Okay, that's risk-weighted 0. Okay, for example, U.S. Treasury, AAA, U.S. Treasury under the control of Donald Trump regime. I have to be careful, right? But let's say some risk-free asset like Singaporean Treasury bond. Okay, you may have invested in Singaporean Treasury bond, AAA rated, no chance of going bankrupt. They will repay you whatever happens. So safest asset. Okay, AAA rated, government bond, risk weighted 0. Okay, you don't have to worry about it. Okay, risk weight 0, RW, risk weight 0 means you don't have to worry about it. Okay, but as your investment portfolio gets risky, you want to perceive some proportion of it, those asset, as your something called risk weighted asset. The weight of risk will be more positive, going to 1 or 100%. Okay, 100%. For example, derivatives transaction kind of things, right? Very risky. Okay, so whatever amount that you are exposed to derivative transaction, 100% of it should be recognized as risk-weighted asset for that part. Loans and then something in between. Okay, you may have different risk weights, like 50% or something for some loans or whatever. Okay, we're gonna talk more in detail with more concrete number in the next slides, right? But risk-weighted asset will be there, so that you compute the risk-weighted asset in aggregate level, and then compared to that risk-weighted asset, how much of a buffer capital that you have, so much so that you can tolerate any negative shock, right? In Corona-19 kind of, negative shocks, right? Can you endure? Okay, that's called BIS ratio. Okay, so you need to have a certain level of enough of equity capital to sustain and to be called as a safe bank. And in 1988, they said this BIS ratio, or the equity, the buffer capital, total buffer capital, has to be 8% of risk-weighted asset. Why 8%? Don't ask me. Out in the blue. Okay, but they just said it. 8. Okay, maybe the prevalent interest rate, annual interest rate at that time was like 8%, or 1988, 8%, 8%, maybe. I don't know. Why not 7.9%? Why not 8.1%? But they said it. Okay? And then why did it become such a big issue in Korea? 1997. Well, East Asian financial crisis they hit, and then the BIS and the IMF came with this textbook and said, Korean banks, right? What is your BIS ratio? And then we got hit by negative shock, and then this loan, asset amount, right, was shrink down, and then deposit amount still there, right, still there. Okay, deposit amount still there. This equity capital had to shrink down, and it's below 8%. You are in trouble. And then this crisis was even more exacerbating itself, because we were not satisfying this BIS ratio standard. Okay, so we're going to get back to that point later on. Anyway, so the next one, okay, risk-weighted asset. Yes, right. Risk-weighted asset, the concept with this more concrete numbers, right? Here, 4 categories of assets we can label it. Okay, of course there are hundreds of different items, which is like driving people crazy. Impossible to memorize anything, right? But the key idea is this: more risky asset more risk weight that you get. Okay, so that you want to be more prepared for that. Okay, that's the idea. 4 categories. 1, government bonds, risk weight 0. Okay, can you see it? Expand the picture. Yes, sorry if you don't like my whiteboard writing. Why don't you write it on the electronic things, right? It's inaccurate, right? So at least I show you the snapshot with more precise picture in it. Okay, you can pause and write down. Okay, go ahead. Now the risk weight 0 is there. Safest asset, government bonds of Singapore. Okay, short-term interbank assets 20%. So interbank means like high quality bank transaction between JP Morgan versus Bank of America or Citibank or this kind of big guys playing with the big boys now. Yeah, those big corporations, big banking corporations, right? 20%. Not just the big guys, but interbank wise, right? It's 20%. Residential mortgages or other loans kind of things, 50%. There must be a spectrum, a lot different numbers of weights. So complicated. Okay. But I'm not going to test you on memorizing all these things, right? But the idea is, as I said before, more risky assets, more risk weight should be calculated like that. So here's that's the one of the ideas. And then for bank quality analysis, or there is something called CAMELS analysis, when you are analyzing the bank's stability or the health of the bank, right? Here is one representative way of, or the frameworks of analyzing banks, right? So let's see. CAMELS, NACTA? No. What does that stand for? CAMELS stand for 6 aspects of bank quality or strength. So C stands for capital adequacy. You need to have enough of buffer capital. And asset quality, which means I should expand this one. Okay, fine. I'm going to stand over here. Okay. Actually, this is what I got trained at Bank of America as a corporate credit analyst. Okay. And then sometimes at one point, I was working as analysts for correspondent banks. So whatever banks that we transact with, right? So IBK, 기업은행, or 산업은행, or 국민bank, or whatever. Okay, I had to analyze their financial strength using this CAMELS analysis, right? So this is a bit different from the usual non-bank manufacturing companies analysis, right? Capital adequacy comes first, right? How much of the buffer capital that you have, right? Relative to your risk-weighted asset. Do you have enough of tier 1 capital ratio or BIS ratio satisfied? That kind of things. Asset quality, when you look at the loan portfolio, okay? This 기업은행, let's say for example, they lent a lot of money to like Daewoo Motors or something. Daewoo Motors unfortunately hit bankruptcy, which means the 기업은행's loan portfolio value shrank down. Asset quality, that was 20 years ago. Management quality, you look at the CEO and the top guys over there. Aren't they just a robot? No, they are important guys. They're most influential guys in the organization. Who you have on the top position really, really, really matters, right? How smart are they, essentially, okay? So that's management quality. Earnings, right? Net income or the fee income or this kind of things, right? Interest income that you get from the bank, and then you have interest expense. What do you mean? Well, for this one, earnings, right? This is where the banking is where money is raw material. Your cost of goods sold is money. Okay? You have this alchemical magic called banking business. Your raw material, the soup, is money soup. Yes. And how much do you earn by selling this money soup? That's banking business. Your raw material expenses, the cost, that's your borrowing cost over here. Okay, deposit rate. Okay, you give some interest to your deposit clients, customers. That's your cost of goods sold. And you issued some corporate bond as IBK 기업은행. Okay, well, you had to pay some interest regularly to your bond investors. That's your cost of goods sold. Okay, instead of saying cost of goods sold, we say this interest expense. Okay, and that is associated with this liability section of your balance sheet. Make sense? Right. So that's the cost side of it. And if you look at the asset side, your loan portfolio, right, or your bond holdings, right, you have AAA rated bonds, and then that's generating, giving you some interest income to you. That's this revenues, interest income. You get some interest income from your lending to Samsung Corporation. That's your interest income revenues over here. Okay, and then after that you get some net income, earnings, right? Earnings. And then earnings quality, how sustainable is it? Okay, that's the idea of the purple star over there, right? And then the liquidity, what does that mean? Well, when you think about this, portfolios of assets, right? Some corporate bonds, how frequently can you sell it easily to the market? Okay, so that you can cash out most of it. Okay, the maximum amount, you can cash it out immediately. How liquid is the market? And then how liquid is your loan portfolio, so that you can sell off some loan contract to the third party, right? And then the liquidity of these AAA rated securities, okay, of course, they are the best one, right? Those liquidity in the capital market really matters, right? And then sensitivity, well, depending on the business cycle, how much of these 5 elements move, okay, sensitively to the macro shock, okay, in various scenarios, okay. Those kind of ideas are there in CAMELS analysis, right? So that's it. Now, yeah. Examples of capital, what is it? Capital adequacy, numerical example over here, right? I show you. Okay. Let's see. In this numerical exercise, you have a bank whose asset, you have $100 million in each of the 4 categories, which is government bond, short-term interbank loans, residential mortgages, other assets, right? In total, you have $400 million worth of assets, okay? And then let's call it, that's total asset, $400 million, total asset, okay? But you have to get the risk-weighted asset to satisfy this regulation. So the weight of government bond is 0, short-term interbank loan, 20% of it, residential mortgages, 50%, other assets like derivative transactions, 100%, okay? So once you cross-multiply all these things and then get the aggregate amount, right? Then you'll see, this, that, right? And then you'll see that the risk-weighted asset is $170 million, right? Now, if your risk-weighted asset is $170 million, what does BIS say? What does BIS Accord say to you that you need to have as a buffer capital? Well, you need to have 8% buffer capital, okay? So multiply 8% to this risk-weighted asset, you will see that this has to be $13.6 million. So equity over here has to be $13.6 million, including this, the purple part, right? And they have another regulation, okay, that says we want a majority of your buffer capital to be core capital, your common equity plus retained earnings. Otherwise, you will take opportunistically behave. You will behave opportunistically, so that most of your buffer capital may come from preferred stock or subordinated debt, and your own equity is just nothing. We don't want that to happen, because that's going to create some moral hazard. Okay, it's not going to create, but it is a symptom of moral hazard, right? It is. So we want to prevent that kind of situation. So we want to have enough of your, or more than 50% of your buffer capital to be something called tier 1 capital. Tier 1, tier 2. Tier 1 means the core, most important one. Tier 2 is like second tier, like the next level. Okay, that makes sense? Initially, I had a hard time digesting the word tier. What do you mean tier? I know the necktie, T-I-E, the tier.
타임과 일치하는 작품입니다. In time, time to kill,
What?
about time. Once.
Oh, Siri, you cannot help it. Tier 1, tier 2, right? She's also troubled. So that's why. Anyway, but that's about it. So 50% maximum, tier 2 out of minimum capital. So multiply 50% to this, 13.6, then you will get $6.8 million. So this will be the maximum of tier 2 capital allowed according to BIS, right? Once you satisfy this 8% regulation. Anyway, so that's how the regulation works to judge the capital adequacy of your bank, right? And could you give me some real world example about the tier 1, tier 2 capital ratio? Yes, for that question, I brought a page from JP Morgan Chase's first quarter earnings report of 2020, most recent one. Okay, and there you see in one page in the PowerPoint, they show the Basel standard. It already says Basel 3, right? Basel 3. So we're gonna get there later, but what I want to highlight is this tier 1 capital ratio. And Siri keeps on bothering as I say tier. Yeah. Anyway, tier 1 capital ratio and total capital ratio. Okay. This is total capital ratio is like tier 1 plus tier 2. Okay. The whole buffer capital, right? CET1 is like even more strict rule of focusing on the core capital. Okay, so let's look at it. Tier 1 capital ratio 13.3%, and then 1 plus 2 15.5%. Very stable, how do you say, solvent bank, right? And the solid one, okay, they call it fortress balance sheet, right? It's so strong in terms of this buffer capital. We have enough of buffer capital. It's like a fortress. You know, dare to compare with me, kind of idea. Okay. Now the the risk-weighted asset 1,600 billion. It's 1.6 trillion dollars. And then in contrast, you see a total asset 3.1 trillion. Okay, so 3.1 trillion of total asset, but if you get the weighted of this assets, risk-weighted asset is about half of them. Okay, and then based on this, the half of this, based on this risk-weighted asset, you compute this total capital ratio and tier 1 capital ratio, right? And then CET1 capital, that's a new regulation associated with Basel 3 kind of things, or 2, I don't know, okay? So, oh wait a minute, if you compare this ratio with the prior quarters, right, you can see a little bit of time trend going on. So you can play with that a little bit later on. Anyway, that's that. That's US example. Could you show me some Korean example? And this is Korea, Shinhan Financial Group, right? So this is perhaps the most solid bank in Korea. Used to be the best bank in Korea. Okay, not in terms of size, but they're reasonably number 1 to 3 guys in terms of size, but in terms of profitability or capital adequacy. Okay, even until now, that's pretty much there. Okay, once you set up this kind of risk culture, it sustains. Shinhan Bank, right? So BIS ratio, tier 1 ratio is there. What is that? BIS ratio is 1+2, tier 1+2, as you saw in JP Morgan's case, right? JP Morgan, they showed it at the bottom, and CET ratio, they showed it at the top. Cultural difference maybe. Asia, we show it with the bigger picture and then narrow down to core of the core. Whereas in the US or European, you start with the core and then the individual, the important thing first, and then wider town, and then the bigger country address kind of things, right? You widen the scope as you go on, right? It shows up over here. Anyway, the BIS ratio 16%. What is that? Shinhan Bank, right? And then the blue bar, blue charts, right? Is the Shinhan Bank performance last 2 years ago, 1 year, last year, right? And then this quarter, right? Snapshot figure is shown. 15.5% tier 1 ratio when it comes to the Shinhan Bank, the depository institution of Shinhan Banking Group, okay, Shinhan Financial Group. So Shinhan, I say, Financial Group, okay, is a bigger one. Shinhan Financial Group is a bigger guy. Shinhan Bank is a depository institution. Shinhan Financial Group, they have a lot of different subsidiaries, like investment banking unit is there, and then other asset management groups are there, right? So, but focused on the depository institution, the biggest one, right, is this Shinhan Bank, right? And then JP Morgan, by the way, they have a whole bunch of them, consolidated basis, which is like a financial group, and they also have some banking unit in it. But what is reported in the financial statement over there is this bigger group, I guess, right? We need to check it. But to be, if you want to compare Shinhan Banking Group with JP Morgan, I would say I would compare this guy, 14.1%, versus JP Morgan's, what was that? 14.1. Total capital ratio, yeah, 15.5% for JP Morgan, 14.1 for Shinhan Bank. So which one is more, how do you say, is solvent? Which one bank is more stable, okay? Which has better balance sheet? JP Morgan, right? You can clearly see it with this number over there, okay? And tier 1 capital ratio 13.3% for JP Morgan. Let's look at Shinhan Bank, our good old friend. Yes, 13.3%. Tier 1 13.3 to 12.6% over here. Group as a whole has been a little bit deteriorating, okay? And then CET1 ratio, that's core of the core, right? Usually it's like common equity and the retained earnings itself, right? Tier 1 includes something more to this one, some more, okay? The detailed amount, God knows, you know, you can go ahead and play with that, but I don't, you know, care about it too much. Anyway, so that's that. Next one. Capital adequacy standards. While traditional bank capital standards protect depositors from traditional credit risk, they may not be sufficient protection from derivatives risk. So what I'm trying to say is that Basel Accord in 1988, right? Basel Ba, and then 8% rule over here, right? Easy to remember. Ba, 8. They were hung up on this credit risk loan portfolio only, okay? But later on, after 1988, in 1995, there was a dramatic event coming from Baring Brothers, right? Baring Brothers, they got screwed up, totally bankrupt, right? And then, as I told you before, because of the rogue trader, how do you pronounce it in French? Is it rogue or rouge? Trader, Nick Leeson. I want you to watch this movie. You click this one, okay? Rogue Trader, starring Ewan McGregor. If you watched Star Wars several times, you must have seen this guy. But there was a movie, 1.5 hours about it, okay? About this guys, right? Okay.
Makes me your boss, Nick. Nice to meet you.
Hey, how do you do?
Very well, thank you. Okay, let's see the action.
All right. So how did this derivatives trader?
So who's doing all the business? We're the biggest, right? Well, we do a lot of arbitrage.
Before Barings Bank, the bank regulators like BIS, they were so much hung up on the risk of the loans in the balance sheet. But Barings Bank event brought the importance of the derivatives market transaction. How risky this is. This can screw up the bank in one shot, right? Even the 300 years old bank, Barings over here, right? So let's bring in the market risk. This part of risk is called credit risk, and that part of it is called market risk. The risk coming from the capital market transaction. Okay, risk coming from capital market transaction, right? So let's bring in to capital accord over here, right? That was the idea. So they raised the versioned up the Basel Accord to Basel II. Has been endorsed by central bank governors and bank supervisors in G10 countries, right? G10, group of 10. Sets out, okay? It sets out details for adopting minimum capital requirements. The key variables are the key variables the bank must estimate are the probability of default and the loss given default for each asset on their books, right? So not just the market risk, right? Not just the market risk coming from derivatives or FX transactions, but also for loan portfolios, right? Loan portfolios. Let's be more scientific over there, okay? So if you have taken financial institutions management class before, this may be familiar to you, must be familiar to you. And then some of the investment classes, right? Probability of default, right? What's the chance of your borrowers, corporate borrowers like Samsung Electronics, going bankrupt? What's the probability of this, right? Going bankrupt. Number two, once it hit the bankruptcy, how much, okay, what percentage can you really bring back, okay? Not 100%, typically 30% or something only. 70% you lose, right? But 30% or around that part, you can get back. That's loss given default, right? 70% must be loss, right? So 70% must be loss. 30% is something you can scrap out. Okay, 70% loss given default. Different assets, different companies, different kinds of industries have different loss given default. For example, if the industry is steel industry like POSCO or ArcelorMittal, right? The Indian steel manufacturer, US Steel, Bethlehem, or Nihon, like steel manufacturers, right? They have a lot of hard assets and collaterals. So in case they go bankrupt, you can sell off their collateral and then get back the cash, right? So the loss given default will be small. The recovery amount will be huge, 70% or something like that, or 80% maybe. Depends on the industry and it depends on the business cycle. On the other hand, if it is Netflix, right, or some kind of high-tech companies, they don't have a lot of fixed assets, okay? So if they hit bankruptcy, well, pretty much almost all of them, you cannot recover, okay? No collateral, almost no collateral. Your loss given default will be huge. Recovery rate will be very small, right? So that kind of things should be incorporated. There is a financial engineering, whole discipline of financial engineering. People take master's level degree for this one. Takes about 2 years or 1.5 years, and you need to do a lot of probability related calculus, right? Advanced engineering math to master all these things. So that's it. I'm not going to ask you too much about it, but this is the idea. Let's be more scientific in calculating all these things for capital adequacy standard. So Basel II, right? People typically picture it this way, just like a Greek Parthenon, Shinjan or Parthenons, you have a lot of pillars, Dorian pillars, 1, 2, 3. So what is that idea? Pillars of Basel II. One is minimum capital requirements. Let's make it more scientific and sophisticated. Incorporating credit risk, market risk, and operational risk. Marking to market for traded assets. Operational risk, what is that about? Well, this is about trading mistakes. For example, we call it fat finger mistake. What do you mean? You punch in when you buy and sell securities, stocks, right? You place an order punching in the number somehow with your fingers, right? But what if your finger is so fat that you punch in your two keys at the same time? You intended to punch in 1, but you end up punching in 1, 2, and then end up punching in the wrong number of shares to buy or sell, or the price that you want to sell at. You're screwed, man. So operational risk is there, okay? Which has nothing to do with credit risk or market risk itself, right? And then market risk, they bring in this concept called marking to market, okay? Marking to market or mark to market. What's the idea? What's the idea? When you look at these loans, right, in the balance sheet, I'm going to expand the screen one more time, okay? When you look at the balance sheet over here, okay? I labeled one thing as loans, right? But what if you have some corporate bonds? Okay? Corporate bonds. For example, let's say ExxonMobil. XOM. Right? XOM. John D. Rockefeller's company, right? AAA company, yeah, of course, no problem, right? So the corporate bonds should be high grade, very good corporate bond. But what if right now the oil price is screwed because of the price war between Russia and then Saudi Arabia, King Prince, right? Bin Salman, whatever he does, right? Oil price was plunging down to negative range, right? The thing is, the quality of this Exxon heavily depends on the oil price. If the oil price tanks, their company value goes down, right? And what about their corporate bond value, right? if the oil market sucks like crazy over the long run, 10 years down the road, then this value may be eroded. Okay? And then the mark to market says, well, if your bank, Shinhan Bank, let's say, Shinhan Bank holds ExxonMobil's corporate bonds somehow, then how would you represent it in the balance sheet? In recording balance sheet, we used to record it at historical purchase price when Exxon was performing great. But as this company sucks, this corporate bonds value goes down, then you have to mark it to market so that the value of the bond will shrink down. So that's the idea of marking to market in real time. Now, what's the unintended consequence? What's the unintended consequence with this? The good part of it, positive side of it of marking market is being real time and being scientific, okay? But what's the negative consequence here, or unintended negative consequence of it? Well, there are some times that the financial crisis happens, okay? Financial crisis happens like 97 East Asian financial crisis or 2008 financial crisis, okay? All of a sudden, for some, reason of bubble bursting, okay, bubble bursting, so that the capital market tanks, and then the corporate bond market tanks. Tanks means like plunges, okay? Corporate bond market plunges for some reason, called financial crisis, and then your bond holding, okay, holding of corporate bonds, its value goes down, shrinks down together with the financial market crisis, okay? There's a chain reaction with it. There's a chain reaction. What is that? Well, you held on to this corporate bond, its value shrank down like half, okay? And you have to mark it to market and represent it in the balance sheet. Now, your corporate bond value is only half of what it used to be. And your whole balance sheet shrinks down. And what remains of you? Balance sheet has to balance each other out. Asset has to be liabilities plus equities. The liabilities doesn't go away. Your depositors still hold on to it and say what? I want my money back. At random time, you have to pay them 100%. But this guy shrink down, which means your buffer capital equity has to shrink down. You are in even more distress. Okay? You're in even more distress because of the marking to market. And it's self-fulfilling and reinforcing. Your bank, remember you are Shinhan Bank, such a great position in the financial market in Korea. Your balance sheet looks worse because of the marking to market. And people, investors in the capital market are scared even more. And then they sell all the corporate bonds even more, so that the bond value of ExxonMobil or whatever bonds that you hold, the value shrinks down even further. Okay? And then your equity capital balance each other out. And then the trouble becomes even worse and worse and worse. Okay? Marking to market has a negative side, unintended consequence like that. Now, what is unfortunate about East Asian financial crisis, especially Korean market, is this. The IMF and then the Western banks or those lenders, right, came to Korea and said what? Oh, you guys have to market to market. Follow our footstep, and we are marking it to market. The Western guys in 97, they were in a healthy position and they were doing market to market without any problems. So we had to follow marking to market, which exacerbated our balance sheet, bank balance sheet like crazy. Okay? So that was adding to more crisis, right? Chain reaction was happening. Okay? The IMF, they had no idea about the East Asian situation, but what they were experiencing was Latin American situation, and then they were imposing one size fits all policy for everybody else, right? So they were forcing this kind of things to our situation. At least in journalists or in the mass media, they were spooking even more. Oh, you have to market to market, and then which was spooking it to the investors. Now, 10 years later, in 2008, guess what happened? Lehman Brothers and AIG, all these American financial institutions, they had encountered the same problem of marking to market. Now what did they say? Stop marking to market. Now we realize how troublesome this is. Stop it. And they stopped it. What is that? 억울하면 출세하든가. 그러니까 you have to be the big guys in the first place somehow in this financial market, which just sounds kind of funny, you know. You have to voice out. Okay, you have to voice out. If you're, in 1997 East Asian situation, we were more like conforming to the regulation. The big guys say this, and we have to follow marking to market. Actually, turns out we did not have to. Maybe, okay. They are not doing it in their own trouble. Why did we have to, right? So this kind of grumbling is always there. Anyway, so that's it. Now, it's all about politics, by the way. So marking to market. 열폭했어, right? Okay, fine. Number 2, supervisory review process. Banks are required to conduct meaningful stress tests to see if they could endure extreme economic situations, right? So, especially after 2009 financial crisis, the banks in the US and in the world, they are diligently going through stress tests, right? And effective use of market discipline. People try to be more transparent in disclosing public information or the key information. Okay, key information. Now, yeah, my dog is barking, so I have to stop it in any given time. Basel III is in place since 2019, Tier 1. Okay, only common equity plus retained earnings. Tier 1 capital to be increased from 4 to 6%. The regulation standard says that you have to be more solvent, right? More buffer capital to secure financial stability, and things like that. Okay, much more, bringing more scientific tools, stress tests, and all these kind of things. What's the consequence? Well, since COVID-19, the financial market is doing relatively okay so far. So people were like, initially panicking so much. I was one of them too, like, oh my god, we are falling, right? But I also said it, right? Once the thing is, the financial stability is there, right? It's not like 2008 financial crisis or 1997 financial crisis. It's more like Great Depression, even worse, right? But one thing is that the financial system is healthy until now. Okay, because of the regulatory reform that we had over the last decade, right? So that's partially why there was a significant bouncing back in stock index, S&P 500 that you see it, okay? Well, it's only 2 months, right? 2 months. I told you in a previous slide in my blog, right? It's not a matter of 2 months. What will happen 3 years down the road is the more important question. But one thing I want to highlight is that we have relatively more stable financial system, more reliable than before. So that's why we had some quick bounce back. Okay, it's a different kind of crisis, right? It's not about finance so far. Okay. Going into the future, 1 year, 2 years, 3 years down the road, are we going to follow the Great Depression's footstep, where we had 90% plunging of price with bouncing back and bouncing back and bouncing back? Or would we go up or stay the same? Okay. It really depends on international political coordination. Okay. between the US and China, among Europeans and then Asians, countries, all this kind of international coordination in political sense as well as medical sense, right? Supported by financial system. At least the financial system is there for you. Why don't you cooperate? Okay, and then what's next? Whether this guy will go up or down, right? Right, depends on political stability or coordination. Where Donald Trump seems to be like pulling out, screw on, right? And China is also like pissed off, right? So that's tough part. Now, what else did I try to say over here? Right. Yeah, the number two thing is that even though the financial system is stable, okay, solid, in the long run, we cannot guarantee. Why? Because those loan portfolios, the banks, lent money to real world companies. Korean Air, Asiana Air, US Airway, what's that? United Airs, like Northwest, Delta, right? These companies, if they go bankrupt, the loan portfolio of Bank of America, Chase, JP Morgan, right? Or Shinhan Bank or whatever bank, their bank balance sheet will tank down in the long run. Okay, as manufacturing or the real, the non-financial business goes down. Okay, so in the long run, that is a serious risk. Okay, that is a serious risk. So it may be self-fulfilling in the future, 1 year, 2 years down the road. Okay, so that's something we have to be really worried about. But the government so far in Korea, okay, they have been very doing good job of sustaining this real business, and U.S. Central Bank and then these monetary authorities, they are doing good job, right, in stimulating those consumptions, right. This weekend, my family, right, they went out for shopping a little bit, right, and then they found a lot of livelihood in this market. I hope that's not spreading the virus. Hope, but to the minimum degree, at least we have some good stimulus packages going on. That's good. Anyway, that's my message, and then let's go for the next slide.